Hi. We're starting a little bit late. We've had some technical difficulties, but you've just tuned in. We're Real Estate Masterminds. I'm Leslie Smith, and I've got my guest here that I'm going to interview, Jim Fring. And he's from Wisconsin, looking at his portfolio, part of his portfolio, that's here in California. And we're going to speak with him. I'm going to interview him, find out how he built his portfolio, some of his priorities, his background, and then we'll take questions from everybody after that. I may change that in the middle, but right now that's my intention, is really to do the interview and then we'll go to questions. And at that time for you, if you're on the web, I will give you a text number and you can text in questions. But I'm going to wait to do that. So we're going to start here with Jim. So Jim and I know each other because we share the same real estate agent, Marty Stone,
Yep.
and he's been great for both of us, helped us with our portfolio, incredible guy. How did you come to know Marty Stone?
I met Marty through a friend who became a business partner of mine, and I don't know how he met Marty, but Marty taught both of us the real estate business, at least investing in apartment buildings.
Uh-huh.
And then it took off from there.
Yeah. Marty's amazing.
Yeah.
And how did you start your portfolio? What did you start with? Was it real estate or did you start with manufacturing? Well, why don't you start with what you have in your portfolio?
I have about 400 units and spread among Texas, Colorado, Phoenix, and mainly Long Beach, the Long Beach Lakewood area of California.
Right. And are most of your units, I believe, are in California? Is that correct?
About a third.
A third.
Yeah. A little,
So,
yeah.
so, and what else do you have in your portfolio? You're really diverse, which is interesting to have this much in real estate and then also have other things that you're in. Can you talk about some of the other directions you've gone in?
My main business is a manufacturing plant in Wisconsin. We have about 200 employees, about $25 million in sales. We do metal fabrication for people like John Deere, Harley Davidson.
Right.
I'm involved in a small bank. Also in a software company over in Ireland, and we do hospital administration software. And I actually own a portion of this little, we call it a movie studio,
Right.
But we do movie reshoots and commercials and TV shows here.
Right. So isn't that interesting? He has this huge portfolio, and what do you do after you have that big of a portfolio? Well, you buy a movie studio, right? So he and Marty, the real estate agent, they bought the studio together. So I think that's just kind of entertainment to be in another sector and something. Is that correct?
Well, our partners think of this as the movie business. I think of it as commercial real estate, you know? And yeah, we lease long-term and we rent out short-term, and we also rent equipment. So
Right.
it's, again, I think of it as commercial real estate. So.
Right. And what prompted you to buy, here I think it just sounds like it was kind of fun, and you have enough assets and other things, and being in a studio in LA was fun. But were you motivated mostly, it sounds like, by the real estate part of it?
Correct.
Not as much being in the film business?
No.
No.
That was not an attraction.
Right. Isn't that interesting? He's that clear. It's about the real estate, not the studio. So that's interesting to me. I thought it was kind of about the film studio, but I get it. Yeah. And it is doing well, isn't it, the studio here?
It is, yeah.
Yeah.
We've got, we do music rehearsals, so some of the biggest acts in the world rehearse here before they go out on tour.
Right.
We do movie reshoots, and we have several TV shows going on right now.
Yeah. So you're out just checking on all the portfolio out here, and you live in Wisconsin, which is where your manufacturing is, I believe.
Correct.
Right. So how did this all start? Were you little and you said, I want to be a mogul and I want to own all these things, or was your dad a role model to you? How did you get the spark in your eye to create this portfolio?
My dad was a small town lawyer, and wonderful father, but not really a business person, you know. Mm-hmm. So I went to business school and some things like that, and I ended working for a wealthy individual at one point, and I ran several businesses for him.
Yeah.
And in the process, I acquired a couple small businesses, sold off a couple for him, and then decided to do that on my own. And so I went and I bought this metal fabrication company in Wisconsin.
So how did you get your seed money to start your portfolio? Because it sounds like you were working for him. Maybe you got a percentage of the deals, or you would have to have a pretty good seed money, I would think, to start buying a manufacturing company.
Yeah, the company I managed for him was losing $50,000 a month when I got there. So I negotiated a deal where I would get a portion of anything above a $50,000 loss. And in our third month, we broke even, and after the 6th month, we were profitable. So I made, a fair amount of dough there,
Right.
and
So
that was my seed money.
And how old were you when you were working with that company and the seed money was being
I was probably
acquired?
29, 30, something like that.
Right. And so was this individual also?
Just a couple years ago.
Yeah, yesterday. So was this individual also the person that kind of motivated you that you could be big and you could have this money and go have create a lot of wealth? Or maybe because you went to, I know you got your master's beyond your Bachelor of Science, maybe you already were on that track of knowing that you wanted to create a big portfolio.
Well, I wanted to be an entrepreneur, and I wanted to own my own businesses and things like that. I don't think I ever really determined how large it would be up front.
Right. Yeah.
It just sort of grew organically, and
Yeah.
yeah.
And who continues to teach you? Who do you learn from? Or is there somebody that you learn from? And you still take in knowledge, or a TV show or something, or somebody that you really look up to that kind of gives you inspiration?
I would say my fellow entrepreneurs in Wisconsin, the people that own factories there, we do tend to hang out together a little bit,
Right.
and we have the same problems, the same opportunities in many ways, and so they're probably the people that I learn the most from, and our employees, we have fabulous employees.
Right.
And in the real estate business as well, the people that end up working for you really tend to be more expert about things than you are. So.
Right.
Yeah.
Well, and that's an interesting point is, I just want to say that both Jim and I work with the same real estate agent who is just a teacher. You ask a question and you get a 30-minute answer. So that part's really amazing. So I think part of me working with Marty has been that he's continually a teacher. And what I say about him is it's like having a partner in all of your deals, but he's not on the paper. Because he'll say, oh, why don't you do this, or let's look for this building. And so he helps steer a portfolio versus just helps you buy something.
Oh, yeah.
So,
Yeah. If we're going to improve a property or something, he always gives us an opinion. And
Right.
Yeah, he's fabulous. I learn a lot from him.
Yeah.
And will continue to.
Exactly. And so what's your motivation for having, you and I talked at one point, and I think I know what it is, but I'm going to ask, what's your motivation for building this large of a portfolio?
Well, my objective, I'm a single person, and so I don't have kids to have a legacy with. So I will contribute this to my high school in Wisconsin.
Right.
And so my objective is to make that as large as possible.
Right. So Jim is, as we speak, even though he has 450 units, he's looking for more units now. So I just see him building and building and building. I quit building about 3 or 4 years ago, the real estate portfolio, and it's interesting to watch him to keep acquiring, keep refinancing, keep using leverage and building his portfolio. So I'm inspired and watch him as he has a different track to building his portfolio than I do. Yeah. So are you going to go into any other sectors? You're already in many sectors, like you said, manufacturing and real estate in 4 different states, a startup in Europe, a bank. Is there any other sector you really want to do?
No, I hope not to do any more than that, yeah. But definitely more real estate. And I really believe that I will probably defocus from the manufacturing a little bit and focus more on real estate.
Okay, so can you talk about how real estate has performed as compared to any of the other businesses you've held?
It has performed much better. The manufacturing entity, we started at 2.3 million in sales and 32 employees, and we have 200 employees and about 25 million in sales now. But the real estate stuff really started with a $14,000 investment in a fourplex.
Wow.
In Long Beach, and I was a 50-50 owner with another person.
Mm-hmm.
And so now we have the 450 units, and
So that way, how much was that first investment, did you say?
$14,000.
So was that your down payment or the price of the building?
No, that was the down payment.
The down
Yeah.
payment, so
Yeah.
$14,000.
That was my portion of it.
Right,
Yeah.
so it was a partnership.
Yep.
So did everyone get that? So he started out with a partner and started out with $14,000 and now has built that into 400. He doesn't even know how many units exactly, right? 450 sort of.
It's about 450. yeah,
About
yeah,
450,
yeah.
right? Give or take 3 or 4. And so when did you buy your first building?
It was 1996.
1996. So that's basically 20 years?
Yeah.
My math that's 20 years, right? So that's pretty.
Started when I was 14.
12. No, I think it was 12.
Yeah.
He started when he was 12, and now he's 25. So that's really incredible. And you've been really aggressive, though, about pulling the equity out. What's your secret to have built from one building into 450 units?
I have added some cash, but early on I didn't have cash to add in, so we did just roll them, and I pretty much followed Marty's lead on that.
Right. So has he been behind you and with you since '96?
In California, yeah.
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 Right.
I purchased a couple things without him, but mainly through him.
Right.
Yeah.
Right. And when you say you rolled them, what does that mean? Can you explain what that means?
I got some appreciation, and you have these inflection points in the market, and I fortunately bought just at the inflection point, and we rode that wave, to
Right.
mix a metaphor, and along the way we would sell off one property, use it 1031 exchange, and buy a larger, more valuable property, and we kept doing that, and then I started adding cash to it as well.
Right.
And then there were pauses in the market, of course.
Yes.
08, 09, 10 were that was
Big
obviously-
pauses.
Yeah, that
Big
was.
pause.
And
Right.
that was also a big pause in manufacturing as well.
Right. So you were doubly hit during
Oh,
the,
yeah.
And can you tell me how have you gone through the different down cycles? How has that hit you, and how do you get through it? Is it looking at the long term, because you know long term it's all going to work out?
I would say that's true, and I would say working with the banks to make sure that they understand that you're standing behind these things.
Yeah.
Be proactive with them. We did downsize aggressively at the manufacturing plant, but and then we grew it right back, got most of our employees back. But with the real estate, it was basically, we kept doing the same things that we were doing all along. So
Yeah.
we continued to improve the properties, because even in a downturn, or maybe more in a downturn, you're competing with the guy next door.
To get the renters and to
Right.
keep your vacancy rate down.
Correct.
Yes.
And then all the tricks about getting rentals, like giving free months
Right.
and all that kind of stuff.
Yes. But even through these down cycles, of which I believe you've been through 2, right? Because in
At least,
'96,
yeah.
through 2 cycles, did you ever lose a property or have anything go back to the bank or anything disastrous?
No.
No. Right.
Oh, we've had disasters, but nothing where I lost a property, no.
And the disasters weren't around, they might be around something in the physical level, but it
Right.
wasn't around the cycle.
That's correct.
Right. So that's it. I just want to add to that, I've only held through one real estate cycle that went down, and I was fine. I just held, the values went down, but the rents were there. I had cash flow in a good, solid market that's dense, and I didn't lose anything either, and it really wasn't, I didn't think this last downturn was tough for me at all. But of course, interest rates were going down, so we were all refinancing, taking advantage of more cash flow.
Yes, yeah, without the interest rates going down, we would have been in trouble, I
Right.
think. But also, Southern California is a special case. The property I own in other states did not fare as well, you know.
Right. So so let me just sum up what you're saying is that basically the California real estate weathered the storm a little
Oh,
better.
Yes, much better, much better.
Right.
We always had positive, we never had a negative cash flow month in California, whereas we did in every other market.
Right. And the other markets, I believe, were Arizona and also Colorado.
Houston and Colorado, yeah.
Yeah, Colorado, Houston, and Denver, right?
Correct.
Yeah. So that's interesting to me. What I teach and what I feel, and I think you have the same experience, is that if you're really in a dense area, in a city that has an influx of people that's strong economically, that you can weather the storm. If you're in Kansas, Ohio, someplace in a small rural area, I think it's really, really dicey and really hard to weather it. And both Jim and I own sort of the same type buildings. You have some bigger buildings than I do, but it seems that we both weathered the storms pretty well, or completely well. I didn't lose anything either, by just being in good markets.
Yep.
And buying good, solid real estate. And what's interesting is I've seen some of Jim's buildings too. A guy once said to me, well, you bought really great buildings, and so, you got in early and you bought great buildings. And I said, no, drive by my buildings. They're just buildings. They're not that special. They're nice, solid buildings
Yeah.
that I've worked to paint and make nicer and better, but they're just good, solid buildings. So it's not like you have to hit a home run and have the perfect building. It's just a matter of buying a nice building and getting in the cycle. As Jim said, with 14,000, with the partner you got in and really made that work and started off with what you could.
But it is not magic. You hear some of these guys talk about real estate investment, and it sounds like it's magic. It's really a lot of pick and shovel work, like today, I walked the properties, I looked under stuff, I had to change into the best clothes that I normally wear to come here. But it's not for most of us like a Donald Trump world. It is getting down and dirty and making sure that your tenants are as happy as you can make them.
Right. But that's so interesting because I think of the way you invest and the way that I invest are so different. Like, I'm the one that's down there picking paint colors and weeding, and you're the guy that comes once a year, live by my property, so I'm at my properties more than he is, and I feel like I'm in the trenches and he's more on the phone. Is everything fine? Or I got the check. Okay, just hold the buildings, they're all doing great. So we both, I think, it's interesting that you feel like you're really in there and stuff. I guess today you are, but usually it's pretty
Right.
hands-off for you.
Yeah, most of the time I'm
Yeah.
not, but the pick and shovel work then comes in because I set up a budget with the managers,
Yes.
and we have a stretch goal and we have what's expected, and if they get what is expected, they get a little spiff, and if they hit the stretch goal, they get a little more of a spiff.
Right. So how did they do?
They always get past the expected.
Oh, that's good.
Yeah, and even in the downturns, because you have to be realistic about it, so that they're still motivated.
Right, right. So what, in looking, the market right now, of course, as always, we really don't know where it's going. And you're feeling like you want to buy right now in California, or where else are you looking to buy, or is it just in California?
I would like to buy in California. I would like to buy a little more in Houston. And I would like to start buying in Chicago.
In Chicago, that's interesting, right? And all units, or would you buy anything else?
I like apartment buildings. It's one of the reasons I got into real estate in the first place was to diversify out of manufacturing.
Right.
And apartments have built-in diversification. If you have a 20-unit apartment building, you have generally 20 companies that you can depend on for that paycheck, for me, the rent
Yes.
check, okay? And that's, it's much more attractive than relying on one business like I do in the manufacturing.
Right. Well, or somebody said to me once, I think this is so interesting, is if you own a strip center or a little industrial building, you have to depend on other people to run their business. If they go out of business, you don't get your rent. In apartments, they just have to stay alive. So, that's it.
It's sort of true.
Yeah.
Yeah.
Although you did have something where somebody died, right? Wasn't it you?
Oh, yeah,
Yeah. Yeah, right, anyway, we won't go there. But, yeah, so the other thing about apartments, I think that works, for me anyway, and you've owned commercial and also,
A little bit of commercial, yeah.
and then
not much.
industrial as well?
Industrial, we own our own building, and so that's really the only industrial
You
building.
know, so your interest really, and the bread and butter and the base is to do, apartments over anything else?
Yes,
Yeah,
absolutely.
yeah, that's interesting.
We will do, I'm working on a development up in Wisconsin that is gonna be condos and apartment buildings.
Right. Right. So do you get how many directions this guy goes in? A development here, then he's in Europe, but he's running, how big is your manufacturing company?
25 million in sales, 200
Right.
employees, yeah.
So, and then he still has time to go to Disneyland tomorrow. Can you imagine that? Not usually, but he's finding time to go have some fun.
Maybe not if it's this hot.
Yeah, exactly. So what motivates you? You're gonna give your money to the high school, but what motivates you to keep building as well? Do you have fun doing it? Is it, in each building, what are you looking for in your manufacturing? Is it just you really like to oversee a big portfolio?
I think it's just interesting. The manufacturing is interesting because there's so many numbers to deal with. There's so many opportunities for change and development. In real estate, you can actually participate. Yeah, of course, the money is a motivator, you know, building the portfolio, the estate, et cetera. But it's also, you know, as I was going around to some of the buildings, most of them are places that I would probably not choose to live myself,
Yes.
you know, but there are places that I would be happy to live in if I had that level of income.
Yes.
Okay?
Right.
And so you can help people have a little better life, and that's rewarding to me.
Yeah, I agree with that, yeah. It's sort of fixing things up, beautifying. A lot of the buildings, I know that Jim buys the same type that I do, where it's beautifying something and taking something and bringing rents up and making it a nicer place for people to live. So I think that's kind of
Yeah.
nice. I re-landscaped mine. I actually landscaped one of Jim's
Yes.
buildings today. I was saying, send me pictures, I want to see how it looks. But I called myself for a while a planterfest, because I was planting just to do things to be nice and to beautify the world. So anyway, we did a little philanthropy at Pixie.
Yes.
Is his building.
Yeah.
Yeah.
And it's still is wonderful, yeah.
Exactly. So what words would you have to say to somebody who's just starting their real estate career? What words of wisdom would you like to pass on?
In my real estate class, you know, the dictum was that real estate, the value of real estate was location, location, location. Okay. I believe it's cash flow, cash flow, cash flow. And if you know, I judge a property as an investment based on projected cash-on-cash returns. And if you have good cash-on-cash returns, you can make the facility better, you can figure out ways to compete. If you're buying it for location, if you're buying it for appreciation,
Yeah.
it's speculation.
Right.
Cash on cash is not speculation, it's an
Right.
investment.
Yeah, and it's what it really actually can do right now.
Correct. And that's what helped us, you know, fall back on the
Yes.
cash
Right.
during the tough times.
Yeah.
It wasn't location, you know.
No, and it wasn't appreciation. Yeah.
Correct.
Yes,
Correct.
in the down cycle, the appreciation's taking a nap. So if you have, I've said this before, and you probably agree with it. As you notice, neither of us have like a single-family home here or there in some development in Texas or Albuquerque or something. It's all units, because when the market goes down, if you have that cash flow, and it's worth 200, 300,000 less, it's easier to hold on. If you didn't have the cash flow, then it would be tough for me to hold it in something that I'm not making any money and it's worth $200,000 less and I'm underwater. So that's how I think we're enabled to stay in our portfolio and not have to trim back during a.
Correct.
Yeah.
Now, and I have shifted my strategy over the years. I used to use the appreciation to sell the property and to use that appreciation to buy additional properties. Now I use the appreciation to refinance, especially with the interest rates as low as they are.
Right.
And recently, and I'm currently refinancing a number of properties and looking to lengthen the period when we'll have the low interest rates.
Yes.
So having low interest rates along with appreciation really does change the strategy, we're taking a lot of cash out of these properties right now and going to be putting that into additional ones.
Right. So that's how you keep, can you explain a little bit about, that's how we keep the cash on cash high?
Yes.
Is by refinancing. This is a strategy that we both employ of refinancing a building to pull the extra cash out and buy another building.
Right, you don't want dead money.
Right.
Dead money's...
Dead money.
Yeah, I mean, and, it reduces your risk, but the greatest risk is to do nothing with dead money,
Right.
because you're not going to make anything on it.
Exactly. And just to define what dead money is you maybe put money into a building and you buy it, and then you pay some of your principal, you get some appreciation, your rents go up, your building's worth more. So all of a sudden that maybe $100,000 you put into your building over 2 years, 4 years, 6 years becomes $200,000 or $300,000 in equity you have in your building. We refinance, pull that out, and buy another building. And
Right.
that's how he keeps his cash on cash returning.
Now, having said that, I mean, going through the last recession and some of the other dips, you do learn a few things, okay? One of which is, putting 10% down on a property isn't always the best idea.
No.
Okay? And now, 25, 30% down is more the norm.
Standard. Yeah, that's the standard these
And
days.
so, when we're refinancing these things, we're doing it a little more conservatively than we did 10 years ago.
Right.
Partially because, you
You
don't...
have to. The banks are making.
Well, and part of it is
Yeah.
that, although you could find other sources for,
True. Part of
to
it.
take second positions or something, which is what I did earlier. But at this point, you don't have to do that because, the portfolio is already large enough. So
Yes.
I mean, then it starts getting into greed and
Yeah. Trying to make
everybody knows
every
what happens
penny
when you
worth.
get greedy.
Yeah. So it sounds like a pretty clear philosophy that you've employed. That has it shifted much since you started in '96? You said that it's gone more to now you really believe in cash flow, and that's how you look at your buildings on the cash flow.
Well, and I always did look at, cash on cash. That's been the same. It's what we use the appreciation for. A friend of mine who was a partner in one of the best properties I've got decided to sell his portion to another person.
Right.
And as a result, my opinion is that he's taking on a lot more risk, and he's selling off an asset that is very low risk. Okay?
Is that Pixie?
Yeah.
Yes.
Yeah.
Okay.
And
right. Great building.
great, yeah, it is.
40 units, right?
46 units.
46.
Yeah. And I mean, that has, I've refinanced that on several occasions, and I've used that money to buy more places that, have contributed more cash.
Right.
And if I were to sell it,
Yeah.
trying to find a better deal would be very difficult.
Yeah.
In today's market.
Right. And it sounds like Jim does what I do too, is that I'm not so into selling a building. You have big real estate commissions. It costs a lot to change buildings. We refinance and pull it out, unless a building really is a stinker. But I've only sold 2 buildings in my portfolio. Have you sold many, or are you
Yeah.
mostly, you have sold
yes.
more? Okay, so he employs that more than I do. And so basically just because you're moving up, you're going into bigger buildings, I
Yeah, or
believe.
the asset has really done about as much as you think it's going to.
Yeah.
You know, either the units are really small and you don't think the rents are gonna go up as fast as other rents for larger units, or the micro market isn't gonna move as fast as another one. So that is really, if you're going to exchange it for a better asset, then sometimes that does make sense. Yeah.
Right. So that's where Jim is really, I'd say you're managing your portfolio a little more aggressively than I am, and like really getting the cash flow down. He works with his managers on the cash flow more than I do. I'm more on just the overall keeping it running as best it can. I don't really compare them and look at the micro markets. If it's not working, I would certainly do that. But I generally let the building keep flowing, and if it does something really wrong, or the neighborhood tanks, or the building has some physical problems, then I would sell. But I'm not employing that sort of strategy of trying to really work the units and really make sure I'm in the best exact asset.
Yeah,
So
you're
I'm on cruise control.
your cash on cash is probably higher than mine. I'm guessing, because you do, you operate in a way that it's gonna be more cash efficient, expense-wise, I think. than I
Really?
do. I think so,
Oh,
yeah.
that's so good to
Yeah.
hear.
No,
I thought that you would be doing more cash flow than I would, but that's interesting.
Yeah,
We
no,
don't know. I'd love to look at your buildings and see where mine are coming out cash flow, because I don't analyze my buildings by their cash flow. That's how, this is interesting, because I teach this in my class, how people look at their buildings differently. Some will look at price per unit, some gross multiplier, some look at them for cap rate, and other people, like he's managing them on the cash flow, I'm managing them just as an asset that I want to be, functioning as fully as it can. So we both are approaching them and working them as small businesses, which is what they are in different venues, different ways that we approach that. So I think that's interesting.
right, yeah,
Yeah.
and I just look at cash on cash, so,
Right.
what cash could I get out of it right now, and am I using that as efficiently as possible?
Right, yeah. So that usually means, of course, taking the money out and going into another building. It's not buying Mercedes, and as our cameraman in the back, Andy Allison, said, you take the money and you grow it, you don't show it, right? Grow the money, don't show it. Yeah,
Yeah, I live in a 1,050 square foot house, and that is more than enough for me. What's that?
So do I.
Do you? Yeah.
We're using the same philosophy.
there you go. Yeah.
Yeah.
And what kind of car do you drive?
I drive a Nissan.
There you go.
Yeah.
Right.
I used to
So-
drive a Honda because Honda's a customer of ours, but.
Now you're
um,
driving a Nissan.
Yeah,
Right.
sort of a trader.
So, okay, so what would you say to a new investor going out there and starting a real estate portfolio?
Right now, I would be very careful about values. I was looking at some new properties today, and the prices are really high. I've seen very few properties that I would call a deal. I think you need to find something where there's some value added. So you go in and you fix it up and improve rents. I think that I would, for instance, I am not going to invest more in Denver. I think the market is way too frothy. I believe that the market in Southern California is probably the place I will focus most of the
Right.
money. Yeah.
Right. So that's interesting. I haven't looked at real estate for a while, but I kind of teach, and I want to know what you believe about this, that I always say, like, if I bought a building and it was $900,000 and maybe I paid $940 or $950, it wouldn't matter, because now I've owned them 10 years, and that $50,000 is just the payment on a $50,000 more in a building price isn't that much. And so I'm wondering what you believe about, because it sounds like you're really looking for probably the cash on cash in buying a building,
Yeah.
and that what do you feel about paying a little too much? It sounds like I know the answer to that question, but we're gonna see.
I hate paying too much for anything. Yeah, I would say if there are things about the asset that are particularly attractive, okay, that go sort of beyond, that would make you believe that the cash on cash is going to grow faster, okay,
Right.
like location, okay, that is a piece of that. or the level of risk in the marketplace, or the clientele that would be there. Whatever it is, I would probably overpay a little bit.
Right, but
just to
generally,
get the asset.
but generally, you're really not about doing that.
No, I mean, I
Yeah.
think it's, you have to, part of the thing that reduces your risk is obviously to pound that price down as low as you can get.
Exactly, but I want to say too, and you probably have as well, like I bought one building at the top of the market. I didn't know it was the top of the market, but paid $1.2 million, and within 2 years it was down 300,000. It was worth 900. I got my taxes adjusted, but I got income, and now it's up well over what I paid for it. So in that sense, I don't think it was that bad to have overpaid, because I'm up ahead of it and I've got a good asset
Right.
and all. So
Right.
yeah. But
Um,
that's how, yeah.
well,
I
and
mean,
some of
nobody
it-
wants to. I don't say,
Yeah.
hey, I'll buy your expensive building. But if you happen to and the market goes down, for me, it wasn't the end of the world. Have you bought at the top of the market?
Oh, yes.
Yeah. And how did that, well, maybe in other markets, but in California, how did that work out?
It ended up working out well. I bought right before the decline, this last decline.
Yes.
And we did, that one was a little dicey on cash flow during the worst parts. Our rents went way down, but we did keep the vacancies low. So that one, but now the rents are higher than they've ever been.
Right.
Yeah.
See, so really, he bought at the top of the market, and so did I, and it all worked out fine. But that's because we had cash flow.
Well,
If you were only looking at appreciation in some other money
Correct.
market, you would get double the depreciation, or double the downswing, and a slower upswing, and you wouldn't have the cash flow. So that's where I like these dense markets. Would you agree with that, about buying in
Yes.
a dense market?
Yes, I definitely agree with that.
Yeah.
Also, I think if you try to guess on the timing, you will definitely, over time, you will lose.
Yeah.
So if you can, you need to be buying during the good times and during the lower times, just like stock.
Yeah.
And I bought some assets over in Europe when the dollar was weaker.
Uh-huh.
And
So overpaid probably, or you
Correct.
feel like you overpaid?
oh yeah, and I'm going to keep those assets over there permanently. But I sort of don't care.
Yeah.
But I could have reduced the amount I had to put in
Yes.
if I had just waited 6 months, but I didn't know.
Right.
Who knew what the dollar was going to do?
Right.
You know.
And that's an interesting thing about doing something out of the country. I bought a house in Mexico and did the whole remodel, and the exchange rate was 10 pesos to the dollar. Now they're getting 16 pesos to the dollar. So a huge amount, the money's worth a lot more. So I'm kind of like, oh, I wish I was remodeling now, but you can't time it and know exactly what's going to happen. So,
And you still got a great deal.
yeah, I love that house. It's a great house. Let's see. So what else would you give? What advice as well would you give somebody coming in? What's your worst? I know we had a question earlier from our other cameraman over here that was, what has been your worst failure, and what did you learn from it?
In real estate, my worst failure was a property in Denver, and I'm already sweating just thinking about it. It was a three buildings, 3 stories, 54 units, and it had a design where there were walkways around the 2nd floor and the 3rd floor. And I didn't like the way the rails looked. They looked like a ski chalet, and I just thought it needed updating. So I negotiated a $90,000 credit in the deal. And the job ended up where it was going to cost us about $60,000, so I thought I was a hero, right? And we took the railings off and found out that the walkways were rotten. We took the walkways off, and we found out the stairways were rotten. When when we went from, so the $60,000 job turned into a $350,000 job with those two things.
On a new building, and what was?
Well, it was new to me.
New to you,
Yeah,
yes.
yeah.
And what was how much did you buy the building for? So proportionately?
It was about $4 million.
So
About
$4 million, so yeah, big $350,000,
Yeah.
yeah.
And then when we took the walkways and the stairwells down, we looked in between the floors, and
Rotten.
the floor joists were moved. They were not supporting the load-bearing walls.
Oh my gosh.
They were moved over, and about 2/3 of them were moved over in construction, right? And they constructed the building wrong 35 years earlier, and we had to reinforce or replace 2/3 of the floor joists.
Oh my God.
So that $90,000 credit turned into a $1.3 million fiasco.
Right, which is probably cash. You didn't get a loan for that. That's cash
That
that
was
had to go
all
into,
cash.
so there's a huge
Yeah.
thing, right?
Yeah,
No leverage used, no construction loans, just comes out of the pocket.
yep.
Yeah.
And that was the closest I ever came to losing a property or wanting to give it back to the bank.
Right.
And it was a non-recourse loan, so I could have, but did not do that. And now, we're, it'll take a few more years, but we're actually cash flowing well enough that we're actually getting that money back,
So great. So that's, because you hung in there, right, too? Again,
Yeah.
it's perseverance, it's long-term, it's sustaining,
Yep.
having cash reserves for things that come up, hopefully never anything with that big of a price tag. That was 25% cost of the building was in this
Right.
repair.
Yeah, and reputation, I mean, if I had given that back to the bank,
Yeah,
it would have been bad for my reputation, the business's reputation.
yeah.
I also had a place in Phoenix where we had a very bad vacancy problem,
Yeah.
and we actually sort of left one of the 9 buildings empty, and it was getting squatters in the
Oh my goodness.
in the units of that one building. So we got a group of the current residents, and we called them pioneers. And we told them they were pioneers and they had to hold the fort.
Oh, right.
And so they got very low rent, and we gave them sheets with the number to call the police.
Oh my gosh.
We also recruited police officers, and we gave them lower rent if they parked their squads there. So we did all kinds of things like
Just
this.
got creative with your
Yeah.
management company, right?
Yep, and we ended up selling that property. We actually had essentially, the pioneer building, if you will, we essentially had to rebuild that thing, and we still ended up with a 25% IRR on an internal rate of return.
Right. After how many years was that?
It was about 3 years.
That's, okay, so that's not, that's,
Yeah,
for having
obviously
that,
the market was in our favor there.
yes, but for having that big of a disaster,
Yeah.
that's a pretty big turnaround
Yeah,
and
that was
an
a huge
ability to
turnaround.
still make a profit. So through those failures, they don't sound like failures to me though, because both buildings went on to be, sounds like they were big glitches,
Big glitches.
but not failures, right?
Yeah.
Would you agree? Yeah.
Well-
And nobody wants anything like that, but somehow you persevered through it.
Well, and we looked, frankly, for, now I sound like Donald Trump, but we did look for people to sue, especially during the problem in Denver.
Yeah.
And, the building company was gone. The engineering company and you always have an engineering company come and look at the buildings, by the way.
That's what you learned
Oh,
from it.
yes. Well, we did in this case.
Yes.
And they did not find that joist problem or the rot problem. So we looked at suing them, but then we thought better of it because it's unreasonable to think that you'd open up the ceilings and look for these
Yes, right.
misplaced joists, right?
Right, and they weren't showing up in cracks in the wall or something else they should have investigated.
Yeah, that's
Right.
true.
Right.
And they did not look at the records effectively. They would have found some problems had they done that. So, but we
Right.
still thought that was not worth the effort.
The effort,
Yeah.
exactly. So, how would you sum up what you learned from those failures? Sounds to me like you got creative.
Yeah.
In Phoenix and it sounds like in Denver you couldn't get creative. You had to just do what needed to be done and hang in there.
Yes, and you have to pick good contractors, and you have to have good, one of the things is having good management companies.
Yes.
One of the things I don't like about how you invest is that you're so close to the properties that the risk is that they become personally attached to you. And I don't believe my properties have become personally, I'm not personally attached to them. The distance that a manager gives you is very good for me.
Yes.
And I'll give you an example. At one point in California, there was an old man living in one of the apartments, and we felt sort of sorry for this guy because it just seemed like he had nothing in the world and all this stuff. So we would give everybody else rent increases, but not him.
Yeah.
And all of a sudden, one day, our manager saw him come driving in with a brand new Cadillac, and we went up to him and said, "Hey, where'd you get this?" And he
Yeah.
said, "Oh, I bought it with cash."
Right.
And so we said, "Well, go ahead, we're going to increase your rent."
Yeah.
And he said, "Yeah, I've been wondering why you haven't been increasing my rent." So we don't do a whole lot of thinking about these things personally. They are businesses.
Yeah, the assets, right.
Yeah.
Yep. Well, I think that right now I'm going to call that we take a little bit of a break, and then we'll come back and answer questions from everybody. Kevin, can you give us the number for the people on the web so they can text in any questions? 707, what is it? 707? It is up.
Yeah,
So
it's
look
up
on
on
your
the web.
screen. If you're on the web, you can look on the screen, and there's a text number. You could text questions if you like. We're going to make a 10-minute break and then come back. Thank you. Great.
Okay,
All right.
great.
We will come back and have questions.
All right,
You're all set? You're rolling?
I guess.
Kevin, everybody's rolling? Are we live?
Yeah.
Okay, hi. We're back. Real Estate Masterminds. I'm Leslie Smith, and I'm here with Jim Fring, who's in from Wisconsin to see his buildings and his assets here in California. We've just been talking about his background, his extensive portfolio, and my portfolio, sort of two different ideas of how we manage portfolios and a lot of commonalities in how we manage our portfolios. So we're here to take some questions from anyone that would like to. You can text them in, as we said, on the web, and we'd love to hear from you. So, who has a question? All right, Jan.
Okay, so I was curious because you're in two very different markets, California and the Midwest. And I wondered what you pay your management companies in the Midwest, which have usually typically a lower per unit value to the California. Do you pay a lower percentage on the California properties to manage?
Yeah, that's a good question. No, I believe it's all the same.
And it's how much?
4.5%.
4.5%.
So, and I want
But
to,
then there's some spiffs if they achieve the objectives of the budget, then they'll get a little extra.
yeah. And that's different even in LA. Like Long Beach is inexpensive, 4.5%, 5%, sometimes 6%. And then in LA, it'll be like 10%,
Oh.
8%.
I didn't know that.
Yes,
Okay.
but 8 or 10%, yes, somebody else is shaking, is nodding. So it's really, as Jim said earlier, micro areas have different, I guess, standards and different management practices. So,
Okay, yeah.
yeah. So we
But
like Long Beach
Denver,
because it's inexpensive.
Denver, Houston, Phoenix, they're all 4.5%. Maybe Phoenix might have been 5%.
And
But,
do they
Interesting.
manage your repairs and maintenance as well, or is that a separate contract?
No, they do everything, but in general, unless it's like a very small thing like going and changing a light bulb, their people will be charged out at an hourly rate. So that's on top of that.
I have to get the names and numbers of your management.
Okay, no, I've got Michael Borba at Borba
Yeah,
Management.
he's great.
I'm just kidding, because my family managed the rest.
Oh, okay, yeah.
Yeah.
No, this guy is great. Yeah.
Yeah. Okay, any other questions?
I did have a question just about perspective.
Yes.
Because I talked about the 1,000 square foot house. And during the recession, I was not really very optimistic or happy about
Right.
things. So I was looking at, should I throw in the towel on everything and all that.
Right.
And I realized over a discussion at one point that every week, in fact, it was a little less than that, about every 6 days, I was paying out one of my houses in debt service.
Paying out
So,
one of your
so
houses.
here, I had sized my lifestyle in such a way that my debt service for a
Overall, for
month
all
was
of
more
your-
than 4 times what the entire value of my own
Oh
home
my
was.
gosh, right.
And and my water bill was a half of a house every month.
Right.
So it just sort of, just to give you perspective.
Right.
And I was thinking, what the heck am I doing this for?
Yeah. Well, really, why are you doing that? Why don't
yeah.
you have a big house somewhere?
Right.
Just
You know,
don't need it.
I don't need it.
Yeah.
But anyway,
Or a couple houses.
yeah, it's sort of a weird thing.
Everyone's got their deal. Yes, here we have a question.
First one is perspective, because at this point, you have enough to live. Is this your passion? Why do you keep building? Is there something else you like to be doing, or is just building business what you like doing?
Wait, I want to make sure, are you getting that mic'd? Yes. Okay, so his question is what Jim's passion is and what his motivation is.
Yeah, well, that's interesting. I would never retire, okay, unless I would have to for some reason, because I think I find this to be very interesting. I think all this stuff is interesting, and my dad said the worst thing he ever did was retire. And he wishes he would have just slowed down a little bit. But what I want to do is, my goal is to get the businesses to the point where I don't have to be personally involved with them anywhere near as much as I currently am. I spend, 50 hours a week on G3, which is the industrial company, and then probably about 5 to 10 hours a week on the real estate, and then probably about 10 hours a week on the board activity and stuff like that. I would like to reduce that a little bit, and then I would like to spend 1 to 3 months at a time living at various places, and be able to operate that just with a cell phone and an iPad.
So what's stopping you from creating that now? Or when is that gonna happen? Or is there a timeline? Just curious.
I would hope I could do that within 12 months.
Oh, interesting.
Yeah, and and the way to get there is I have to get the industrial company humming with managers, so that I don't have to be there all the time.
Right, but not selling it, because at one point you and I talked and you
Yeah.
talked about possibly selling it.
Yeah, I don't think I would sell that.
Right,
Because when it's working well, it's a cash cow.
right. So everybody's got that, we're gonna hold him to this, that he's gonna be out in different places, spending some time in different countries or different houses.
Right, right.
There we go. You got
That's-
your commitment
that's
to
what I would
yourself.
like, yeah.
There you go. All right, we've got a question here.
Yeah, you mentioned the market, and you mentioned we should be careful about the values of the market. Can you expand on that?
Yeah, some of the stuff I was looking at today had a gross rent multiplier of like 13, 14.
Really?
Yeah,
That is high, yeah.
that's
So-
really high, And then, of course, it comes down to 11 and a half or something when they give you the performer rents. And you never believe the performer rents. I mean, I think everybody
Yeah.
knows that.
Performer rents, just so if somebody doesn't know, are the potential rents that you think you're gonna be able to get pretty soon after buying the building.
Or that the
performer
broker
rents.
tells you can get,
Right.
yeah.
But then it's up to you to sort of research or
Yeah.
have your management company, usually a good management company can help confirm what the real rents would be that you would get.
Yes,
Yeah.
correct. And then if the cash on cash, isn't really in the 10% range, I really don't like making that investment, unless I really think that with value added, I can get it there, and get it there within 6 to 12 months, and right now, it's hard to find that in any of the markets that I am looking at,
Yeah,
You have to get, pre-marketing deals, from brokers, or again, the value-added stuff.
yeah.
I did get a question from the web.
Okay, so-
What is cash on cash?
What was the question?
What is cash on cash?
What is cash on cash?
Cash on cash is the actual return of cash that is available to you after, your rents minus your actual cash costs. So what do you get for cash? And I look at it on a pre-tax basis, okay? And that's the numerator, and the denominator is the investment that you have in that entity. So
The
in
equity, really.
The equity.
The
That's
equity,
that's right.
Because it went from the investment to the equity.
That's
now,
correct,
once it's
yeah.
grown.
Yeah, when you're looking at it, it's the investment that you have to make in cash. And once, after 2-3 years, after
You've
the
owned it for a
appreciation and
while.
everything, what is the net worth of
Right.
the market net worth?
So basically the equity divided by the cash flow would give you your cash on cash return, right?
The other way, yeah, cash flow divided by the net worth, yeah.
Little dyslexic.
Why
There you
do
go.
you why do you not include the taxes?
Because everybody has a different tax situation, and even I do, and everybody does year to year generally. If you've got investments, it just changes too much, so it's not a good consistent measure.
Well, let's go with Richard Lane
Okay,
first.
so have you looked at other alternatives to 1031 exchange, like a Delaware statutory trust or something?
No, but, we saw something the other
Yes.
day, and I've got to get, frankly, a little more sophisticated about that.
Well, I'll tell you what it is, and I've looked into them. It's Richard Lane brings up a Delaware statutory trust as a possibility to 1031 exchange. We're used to 1031 exchanging from one building into another building. This is a possibility that you go into kind of a large LLC. Big companies do these. I think they're when you kind of want to cash out, you're done, as he said, having the pick and shovel, or me going over saying there's too many weeds here and the paint's chipping. When you're done with the management thing, that you can 1031, not into another building, because it'd be more of the pick and shovel, but you would be going into a big conglomerate thing where they say you're going to get 8%, and when we sell it, you get this percentage, and so it's you don't have this big upside potential. You pay a lot for having this cruise type situation. But I think I could see doing it when I'm much older and want to step out of things, and I think many people do. What?
It's fractional ownership.
Yeah, exactly.
In a big, large commercial building.
Right, so Richard's just confirmed, it's fractional ownership in a large building. So you're not controlling it, and so you don't have the big upside. The developers, the LLC general partners have the big upside. And when you're used to having the upside, like Jim does, he buys a building, he knows what he's making it into, and you 1031 into a larger fractional interest, you know, it's kind of against our entrepreneurial spirit, but there is certainly a place for it, I think, and a lot of people do it, and I probably will at some point.
Yeah, I've gotten to the point now where I really do not like owning a real estate asset without having control.
Yeah.
That's a decision I've made, and that's going to mean that I'm probably not going to grow as fast as I otherwise would. But I just feel more comfortable with that.
Yeah, and I think I've learned the same thing too. It's like I don't invest in anybody but myself anymore. If people have something else or a project, and I can trust myself, and I do my numbers, and I know what I do, so I don't do anything but what I do in myself anyway. Sounds like you're doing that too. So yes, Kevin.
So, you had mentioned that the market's high, things are expensive now, and you also don't recommend trying to time the market. So what would your recommendation for a young couple just trying to buy their first house?
Such as yourself. He's newlywed, 3
Wow.
months ago. Yay, Kevin.
Wow,
Yay.
nice job. Good. Yeah, see, that's one of my failures.
Ah.
I've never gotten there.
But I wouldn't say failure. You're still alive. You never know.
That's true. That's true. In terms of buying a house, I can't render an opinion on that. That's more of a personal taste
I think
thing.
he's talking about buying maybe a duplex or something, and they want to get their first building and get going, and
It
like,
really is in the interest of growing our wealth,
Okay.
and so, we'll live there, but we don't need to continue living there. We're looking for a good investment primarily,
Okay.
and a home second.
Oh, okay. Well, like we were saying, I mean, we might still be seeing this. I know Marty, the broker that we've been talking about, he believes this market in Southern California is going to just continue to be strong for, he thinks years, okay? There's so many factors that can come into play that, Marty doesn't know about even, right? But, and you go into his office and he's got all these charts, and I do tend to believe what Marty says. In general, he is correct. This market will be fabulous for the next, if you look at a continuum for the next 15 to 20 years, clearly this will be a very good market. I don't think there's any doubt about that. What will happen in the next 5 years? So it depends on your time horizon, right? And, but I think you can probably, my guess, and it's just a guess, okay, is that this market will continue to go up for the next 3 to 5 years because the population is growing. You look at the development in Long Beach or many of these other markets.
Yeah.
You can just see it. Every time I come out here, if I'm, if it's been 6 months, it's like a half a block or something, It seems like about a block a year. It just keeps
Turns
moving.
over and
Yeah.
moving up and getting redeveloped and
And it's-
beautified.
Yeah, it's almost a smooth development curve. So I think you could buy with confidence, but don't hold me to that, though.
Yeah, we never
But,
know. We
Yeah, you never know.
But if you are in the long term, like we both did, we held through down markets and he's held through a couple. My dad held through market after market that went down. Never heard a word at the dinner table or anything. He just held. There was no drama or anything. You just held because the market's going to go down, but it goes up and then it goes down again. And it just, if you look over 30 years or so, which Marty has all these graphs, it just continues to go up. But you've got to expect it's going to go down somewhere, and you're probably going to get it, and you might be right when you bought it. Richard bought a building and it went down. He bought right, we didn't know, he bought right when when everything was going down, and he's held. He's done a great job of holding, and it hasn't been easy, but now his building is back up beyond where he bought it. So that's just being smart, sustaining, and now being in for the profits and the appreciation that he wants.
But one
to
thing
have.
I would tell you, I would, my personal opinion is I would do that kind of an investment in as with as little risk as possible, okay? Because, this is your home, it's also an investment. It's sort of like a person going out and buying a company. It was easy for me to do this. People say, "Oh man, how'd you do that?" I was single. I didn't, to a degree. If I failed, who cared, right? I would just restart and it'd be okay. But you've got important eggs in that basket, so you just have to be. I wouldn't over lever it or anything like that.
Yeah.
I can over lever an asset at this point, and there's enough other things that there's diversified into that it really doesn't matter as much. So I can take more risk.
Right. Yes. Okay. Yes.
Now, those two things, now, do you do business as an LLC or as an individual? Do you buy your properties as a company?
I can't wait to hear the answer to this too.
Yeah. I started out because when I started, I really thought it was just going to be a couple of investments, or a few investments, and since it's become a business, now I only buy using LLCs. Okay, I still have some properties that are in my name, and for a variety of reasons, it's sort of expensive to make the switch right now. So you have to time it right, and I haven't done all of them yet. But it should always be with an LLC,
Interesting. I have.
even if you own a share of something.
Why would an LLC watch
It's very inexpensive insurance, and against uninsurable losses. So, if you do have to walk away from an asset and it's not personally guaranteed, then you're protected from that. Or if there are losses like, in our case here, an earthquake or something, you're insulated from that because that's an uninsurable loss. I don't buy earthquake insurance,
None of us do.
Yeah.
That I know, none of us do. Yes. He had a question. Yes.
Yeah, just about the economic downturn of '08. Your properties in Long Beach, did your cash flow on those go down after that?
Oh, yes.
And how much did they go down? in terms of percentage?
I would say, in some cases, they went to nil. They were still positive, but just marginally positive. Okay. The overall portfolio, I was always, frankly, taking, dividends, if you will, out of it, distributions. So I would say it went down by 65%.
Wow.
Yeah.
Wait, the cash flow went down by 65%?
Yeah.
Really?
Yeah,
I
during the
In
deepest
Venice,
part.
it
I
seemed-
didn't think that, really.
Yeah.
In Venice, California here, it seemed like during that time, rents either stayed or went up.
Yeah.
Venice has been, it's like the microclimate has had this huge spurt in value, as you know, that area is really on fire.
Yeah, what happened with us is people started to double up. As they lost jobs and things like that, they would double up. And so our vacancy rates definitely went up.
And then you couldn't get the same amount.
That's correct. When we re-rented,
So
you
it
know,
wasn't renegotiation, it was.
we
Well,
did
lower
not
rents too.
renegotiate.
Lower rents too,
Yeah, but we didn't renegotiate any rents.
or
Well,
loans.
No, in terms of rents, we did not renegotiate. Like during the middle of a lease or something,
Yeah.
we did not do that. But to renew a lease, yeah, we dropped rents, yeah.
Thank you.
Yeah.
I-
Uh, Yes, go ahead.
How do you do your analysis? Because if you're looking at Long Beach, which is, has a lot of people, because it's in the Los Angeles area, how do you weigh the increased cost of that versus something in another state? Because you can buy 3 times or maybe even more in Wisconsin.
Yeah, and that's when you go to the, the cash on cash. So if I could make, if I could get a higher cash on cash return, and you have to compare it to the risk, and that's just judgment, right? And my judgment about this market, again, is that this is low risk, so I'm willing to have a lower cash on cash return in this market as a result, okay? If I were to go to Chicago, I don't know that market as well, et cetera. I would not make an investment there unless my cash on cash return was at least a third more than I would expect here, okay?
Because you don't want to take the risk.
Yeah, because it's got to pay me for that risk,
Right.
so.
Gallo.
You said your first investment was, you went 50-50 with a person. How did that go, and what do you think about going in with people?
Really good question, okay.
So what the question, I'm just want to, because I'm
yeah,
not sure the
yeah.
sound is picking everything up. His question was about partnering with somebody and what your experience is and what you would recommend.
Yeah, 50-50 partnerships, I think, are among the worst, okay, in my experience, okay? And that was with a good friend of mine. We remain, we're still very good friends. But we thought going in, we were both single, and we thought going in, our interests would always be in unison. Well, he got married, and we really split. Our interests were no longer mutual. Okay, and and he is actually the person that is
Chris.
selling out of Pixie. Yeah, and I think it's, like I said before, I think that's a mistake. But and that's one of the reasons I generally, if I'm going to be an investor with 20% or more, I am going to be in control of the investment. Okay. If it's less than 20%, and then I'm less concerned about that. But I really do not. I'm a guy that doesn't like partnerships. And if I've got somebody that comes in at like 10, I've got a friend in Ireland who wanted to invest in the American market, and he came in on one property at 12%, on the other one at 20%, and it was sort of a favor for him.
Right.
But I told him that he has no say-so
Right, exactly.
in what
You're
we do.
running it, yeah.
And
Yeah.
he's fine with that, and it's worked out very well.
And I want to add to that, an agent that I worked with down in Long Beach says that 85% of his listings are because something in a partnership broke up the ownership. So it was a divorce, somebody died. It's not always that they didn't get along, but 85% of the sales are kind of forced sales.
85%?
85%, large percentage, so.
Doesn't mean they're a bad investment.
Doesn't mean, no, it just means that the partnership, for some reason, someone wasn't putting in money, they lost their job, they died, divorce, got married, lots
Yeah.
of different things that who knows, life happens.
Now, and one thing, you can, and I faced this in one case, where I was threatened with the partitioning action, and that's where a minority shareholder can go to court and force an action on the majority owner.
Wow, never
Okay.
heard of it.
Yeah, it's called a partitioning action, and
It
you
doesn't
have to
sound
be
like
very
fun.
careful. No.
That doesn't sound like fun.
Yeah.
Kevin,
Yeah, so I've got another question from online. This person says, I have 70,000 cash, self-employed, and my adjusted gross income is too small for any bank loans over 300,000. Any suggestions on how I can get involved in real estate with the banks not loving me so much?
Well, you do need the banks or a
Yeah.
partner.
What
So
about
the
the
question,
club?
just to restate the question, somebody online has texted in that they have $70,000 or self-employed. Rightfully so, the banks are a little tough right now, and so they're not that excited about giving that person a loan. So they're asking
What were you gonna say?
what they're,
What's
How
that?
about private money?
yeah, they were
Yeah.
asking, yeah, how they can
Private
go
lenders.
forward. Private money or with their 70,000, the banks aren't behind it. Any suggestions
Yeah.
for someone starting?
There are sources, you know, you can get people that will give you a second loan, and that would be a way to do that. Or participate probably as a minority investor. We just talking about that, at the other end of it.
But if you had to, if
yeah.
you needed to come in, like you did in your first building, or my brother did, in a minority position to start building
Yes.
equity, I think that that does work. But do it
And
because
you
you
get
have
to learn from somebody who's more experienced.
Yeah, ideally you get to learn from somebody more experienced, right? And, yeah, so
And
there's,
if you talk to your broker, I bet you could find investments like that that would be available.
yes. Well, and that gets into what Jim and I both experienced, and my experience is that the broker is so key to building these portfolios. It's every step of the way. It's not just selling a property. It's a year later, 2 years later, when they send me an email, oh, we're getting these rents on this street. Oh, so-and-so just did this with their building. It's like a stock portfolio manager. They're always looking at your assets, and they're in there with you. So getting an agent that you really like
And
is
yeah.
important.
And an aggressive, sophisticated broker will also be able to find people that would take a second position.
Yeah, there's
to
a
the
lot of different
second
hats.
position to the bank. So,
Yeah.
and then the bank looks at that note as equity. They consider it quasi-equity.
Right. So that's another thing, like people go in for their first building and they want to use a residential agent to buy a duplex or fourplex. I really, really strongly believe in you working with agents that are really doing the income properties, if that's the direction you go in. Because even something like what Jim talked about is a sophisticated person. And I've been just now bought a house and I got into some sticky situations. And that agent was no help on coming up with ideas, you know, really, let's pay the owner per day to hold and extend my escrow. They just didn't have the bag of tricks that these people who are in escrow all the time, these brokers that are doing those type of buildings that are commercial and residential apartments, they're just working it all the time, top brokers.
And one last thing about that. I would not, my personal opinion is, I would not go to family members for that kind of money.
That's
And
interesting.
it invites so much dispute and controversy that, and I would also be a little concerned about friends in that kind of a situation, because, you know, you may not have enough control, you know, so.
Yeah. And Allison had a question.
I'm finding credit unions are loaning really good money, and they don't have to conform to Freddie or Fannie, and so they can loan what they want to loan. They don't sell their loans on the secondary market, so they're much more flexible, especially with a new buyer.
So
someone
Allison
who
is,
doesn't have a lot of experience.
Allison has just added that credit unions are a great possibility. I don't know about that personally, but that they're much more flexible. So, and I said this, Allison and I had a conversation. She's an investor that started and now has just got a couple of fantastic buildings in Santa Monica. She owned her own company, really, really experienced agent. And we were talking at one point, banks change so much right now. If you went 6 months ago and they said they wouldn't give you a loan, go back now. Everything's changing. New loan programs, that's been my opinion.
Yes.
And my experience is that the banks are lots of new things, and like Allison adding the credit union is great information. Yeah. Gallo.
I have this one building, I just wanna know what your opinion was, because I'm trying to refi it. So I don't have that much, equity in it, maybe 100, 120, something like that. Would you suggest trying to pay that building down, or just wait?
So you think you could get 100,000 in cash out?
So I got it for 360, it's worth, the comp's under 500, and I owe like 2 290 or 285, something like that. When I first asked the bank about the refi, they were like, no, you don't, they wouldn't give me anything until I paid down half of it, 50%.
Wow.
Yeah, and that was like their 2008 protection. But then Leslie was just like, go to a different bank.
Yeah,
Yeah,
would,
I just think
Call
try.
this guy.
You
yeah,
just-
go to
yeah.
a credit union, maybe. I mean,
Credit union loaned me money, I couldn't get a loan anywhere.
yeah.
Okay, so Allison's just added again that the credit union has
And cash out.
cash out refi, and she's retired, she has the income from her building. So again, try a credit union, try a different bank, try the guy I gave you the name of. There might be somebody out there. But
Yeah.
you might wanna wait too and see if you can get, you know, if you do a refinance right now and you get $70,000 out, and if you waited a year and you'd get 100, maybe, then you have to look at what you can do with that amount that you'd pull out,
But
and if you can
interest
do
rates will
anything.
go up. I believe interest rates will go up during that period.
Of course, we've been saying that for
I know-
7
yeah,
years.
that's true.
Right.
Yeah.
Yeah,
Okay, we're gonna do like another 2 questions.
this is a good question.
Yes, here, this one's a good question.
The Dodd-Frank law that's supposed to come out, where the loan's gonna take double the amount of time, is that in?
Dodd-Frank?
Yeah, the
Yeah.
Dodd-Frank law, how is that gonna affect the
But
market?
that's maybe more for personal. That it takes
We're-
like 3 to 6 months to get a loan to buy a house now?
Well,
don't know.
Dodd-Frank is already in force right now.
It's new regulations she's talking about, Steve.
New regulations, okay. As part of it, I don't, I think banks are getting more aggressive in terms
I see
of
that too.
making things happen quicker. I'm refinancing, like I said earlier, and I mean, they're moving really aggressively. I mean,
Yes.
and they still want a ton of information. I mean, you know,
It's
stacked,
ridiculous,
yeah.
yes.
But they are willing to move quickly and be fairly flexible, you know?
Yeah.
Uh,
Maybe that's more on the-
I don't think, I don't feel like it's gonna affect the investment real estate market. I don't know about houses, but investment real estate, it's
Maybe
just a big
houses, yeah.
machine.
Yeah.
It's a big
Okay.
machine and it's very well supported. So, okay, another
This is
question?
more about how you protect yourself, you know, I'm sure, California, the corporate, you know, protection is not as strong as other states, you know, it could be peers. How do you protect yourself from anybody going after you, after the peers, the corporate?
No, my LLCs are all Wisconsin LLCs, you know, and whether that protects me more or not when I'm operating in California, but, you know, if I have an LLC that owns a property here, it is a Wisconsin
Yeah.
corp, you know.
Right.
You know, I mean, my lawyers tell me that I'm pretty well protected, and I think I trust them.
You do until, right?
Yeah, until
I know.
something
So
goes
let
bad.
me,
yeah.
let me bring that up too, though. Since 2002, I've been investing, and I've never had anybody try and sue me personally, and I've had a couple of claims that were small, and the insurance agent, you just hand them to the insurance company and they're dealt with. And one was, a gal thought she got gassed, which was just, didn't happen. And then another one, it was, she tripped and fell, and she really did trip and fall. But they handle it, they paid out
Yeah.
30, 40, 50,000, not any bit of a threat to me. Have you had anything major happen, or not so much?
I had a fellow investor threaten to sue me, you know, and do the partitioning action that I talked about. And he was, I mean, he
Yeah,
was
didn't happen.
a criminal, essentially. I mean, he was sort of a bad case deal. I mean, the odds of that happening, I think, are really pretty low, actually,
Yeah, I
of
think-
anything like that, especially if you don't have investors.
Yeah.
If you have minority investors, I think that's where the lawsuits would tend to come from.
And everybody gets sued in California, so I'm just saying, you know, it's when you're gonna get sued.
Yeah, but you know, I have huge liability, $1 million liability,
Yeah.
or 5, I don't even know what it is, but it's just, yeah, I just don't, I'm more worried that there might be an earthquake than I am about getting sued, really.
Yeah, same here.
Personally.
And you get an
But I
umbrella
don't worry about
policy, you know, a personal one and a business one, yeah.
Yes, okay, last question, then we'll wrap it up.
Jim is, you know, he likes the cash on cash. Somebody asked about it, I still didn't quite get it. I was wondering if you could do a scenario, like say you buy, whatever you buy $1 million buildings, you buy $500,000 buildings. Can you do a scenario about your cash on cash and how that's been successful for you?
Okay, if it's $1 million purchase price, and I put $300,000 down, that is my numerator, so that's the $300 of, I'm sorry, that's the denominator, that's my investment, so the $300,000.
Right.
The numerator would be the cash coming out, so let's say that year I make, $50,000, that's gonna be 1/6, which is, I believe about 18% or something. That's gonna be the cash on cash is 18%. So now let's say that $1 million property goes up to $2 million, okay, and my cash flow is $100,000, and I haven't paid down any of the note, okay, then I would have a $1.3 million denominator, and my numerator would be, did I say $100,000 of cash flow? It would be $100,000, and my cash on cash really sucks,
Yeah,
okay?
because his building's fat, like you said, a lot
Yeah.
of dead money. He's got a lot of equity that's built up in the building.
Yeah. So you're not making money very efficiently, because, the cash on cash went from, 18% down to, probably,
Well-
about 5% or something like that,
Right.
in that
So you-
scenario.
So you have to manage your equity. That's one of the main things that Jim's really good about doing. And when you're building aggressively, you're pulling your equity and building. And you can get to a certain point in your portfolio and just let things cruise a little bit and get a little fatter. But I don't know if you believe this, but I really believe that I pull the cash out just because it's safer in my bank than the bank's bank. And I can do more with it in my bank account than I can in having it in my building. So I pull money out and really use it for my own investment and just to hold as a safety net versus leaving it in the building, even though I'm not still building my portfolio.
Yeah, and the
So-
refis that I'm doing right now, I'm getting a ton of cash out because the appreciation has been so great. It's almost like the scenario I just gave you, and the cash flow, the annual cash flow is not going up as fast as the value of the property. So you're losing what investment real estate is all about, and that's the leverage, so you need to use the leverage when you've got it, and that's right now. When you do have the appreciation, man, you gotta use that, because there will be periods when you won't have the appreciation.
Exactly. And so again, just to be clear, when he says use the leverage, he means refinance and
Yeah.
pull that cash out.
Yeah.
Okay, I think we have to wrap it up though, because it's been a long
She's had
evening.
her hand up.
Okay, one last question.
So,
Jan,
the value goes up, I would have thought, especially in commercial real estate, because your rents have gone up. So did I miss something when you said that the denominator changed? It didn't change? The 100,000?
Okay, yeah, let me use easier numbers for me to calculate, okay. So $1 million, you've got,
Put 30% down.
you put
And
30%
your
down,
rents are,
so it's $300,000 of an investment, and your cash flow is, let's say your cash flow is, this won't happen, but your cash flow is $100,000, okay? That's a 33% cash on cash, okay? And then let's say that the value of the property goes to 1.3 million, okay? But you still haven't really paid down significant amounts of your debt, so you've got $600,000 of net worth, okay? But you still have that $100,000 of cash flow. Let's say your rents haven't gone up, okay? So you still have only $100,000 of cash flow. You've just cut your cash on cash return by 50%.
wouldn't that be a bad time to buy? You just,
this is a highly technical question you're asking. I'm gonna say, go to my last webinar. It's totally about managing this equity. I do the numbers exactly, saying if you have this much in a building and you have this much cash flow, you're making this percentage. So it's all in my last webinar, just so you can look at it. And maybe we can put something on the web so that you guys can see the equation he's talking about. But it really is in my last webinar. It really shows how when a building gets fat, when it builds up more equity, how I always say, like, it's a duplex is a duplex is a duplex. So if you put $100,000 down and it's now 200 or 300 more, after the years go and it adds up, you still are just, a duplex is gonna produce what a duplex does, even though you have all this extra cash sitting there doing nothing. Okay, that's it, we're wrapping this up. Thank you, everybody. Thank you, Jim.
Yep, thanks a lot. Yeah,
Really,
good.
all right, it's been a great evening. All
Thanks.
right, take care. Signing off.